Good afternoon, good morning, everybody, and welcome to CapstoneLaw's Private Market Roundtable Venture Capital. My name is Hans Moritz. I'm a partner with CapstoneLaw, and I have the pleasure and privilege to be the moderator of today's panel. We live in ever-changing times with the presence of COVID-19 affecting every aspect of our business and personal lives. The world of venture capital is not exempt. The outbreak has effectively impacted in record time what has been a steadily growing market opportunity for venture-backed company investors. Over just a few weeks, certain venture-backed companies have shifted from seeking new paths to growth to seeking new paths to merely survive. Others have massively increased in value. Companies must decide whether to raise money now or delay fundraising plans. Companies must make decisions and investors must make their investment decisions without significant time for deliberation and must consider the company's current funding needs, any actual or potential market liquidity constraints, extended sales and payment cycles, and the economic outlook post-COVID. Over the next 45 to 50 minutes, we will discuss the latest developments and trends in venture capital with the following panelists. Ken Lovelace, founder and managing partner of Founder Circle Capital, located in San Francisco. Ken has invested in leading companies such as Anaplan, Carbon Black, Forescout, Looker, and some of which has been acquired by large players like Google and Amazon and other large tech players. He previously spent 15 years with Silicon Valley Bank, working closely with prominent venture firms like Desna Nia and Sequoia, and companies like Android, Facebook, and LinkedIn. Good morning, Ken. Thanks very much for making it so early to our panel discussion.
Thanks for having me.
We also have Mark Seitz on the panel. He's the co-founder and CEO of Seitz Capital, and with over 14 years of investment experience, he leads the firm Direct Investment as a member of the executive and investment committee. Prior to that, he was managing director of Ace & Company, a global investment group, where he led their Hong Kong-based expansions for the group and managed several investment portfolios focusing on Europe and Asia. Good afternoon, Mark, and thank you very much for joining the panel. In addition, we have...
Hi, Hans. Thank you for having me.
In addition, we have Michael Kleinlies, co-founder and managing partner of Blue Horizon Ventures, a Swiss-based venture capital fund with over 150 million in assets under management, basically seeking to disrupt the existing supply chain of food with technology, innovation, and best-in-class entrepreneurs. Plant-based protein, synthetic biology, cultivated meat, and sustainability in the food system are the main focus areas of his investment activities. In his prior life, he was a successful entrepreneur in tech and internet with a couple of IPOs. He exited a number of portfolio companies to the likes like Antenna, 3 RTL, Amazon, Axel Springer, and Deutsche Post. Good afternoon, Michael, and thank you very much for joining the panel. And last but definitely not the least, we have Vincent Oswald, sitting on the panel. He's a hands-on entrepreneur with a strong fund management and financial background. He's a co-founder and managing partner of Enki Capital SA, a Swiss-focused private equity investment firm. And he's also a co-founder and managing partner of Enki Partners SA, a boutique fund structuring and strategic consulting firm. In addition to his involvement with Enki, Vincent is a serial investor in Swiss startups, and he sits on a number of Swiss venture capital boards. Good afternoon, Vincent, and thank you very much for joining our panel today. So let's go into more details. I mean, Ken, maybe the first question to you. I mean, you are very close to a large number of US VC founders as you provide them exit opportunities through your funds. I mean, could you please give us a brief explanation of your investment strategy and maybe explain how Corona has impacted your existing portfolio so far?
Me too. Excuse me. Our strategy was developed the better part of 10 years ago with the thesis that companies were going to stay private longer, and there would be liquidity needs by both management teams and investors as duration in those companies extended. So where a company would have gone public roughly 6 to 7 years after starting for those that are most successful, now it would be 10 to 15 years, and we have seen that play out. So what we do is help management teams and early investors with secondaries. And we focus on those companies that we believe are enduring businesses. Otherwise, those that would be public companies and continue to operate as enduring businesses. And we've been successful in doing that. Over a third of our portfolio companies in our first fund have gone public, and a handful have been within 30 days of going public before they were acquired. So where has that market changed today, and how are we affecting success in that? We have largely been at a ball filled with people of greed over the last decade. Well, there has been a few dancers that have walked into the room that now have fear. So what has happened is the market has become more balanced between greed and fear. And with fear, for us, comes an increased supply of opportunities. And in addition to that, it typically drives down pricing. So for us, our pipeline is 6 times greater than it was in February. And multiples have compressed despite the public market increasing its forward revenue multiples on average, has decreased by roughly 33%.
Wow, that sounds really massive. I mean, maybe Michael. I mean, from what we hear from Ken, I mean, a lot of VC money is allocated to technology and healthcare. I mean, to what extent are you exposed to this industry, and how did Corona impact your existing portfolio? And I mean, from hearing what Ken just said, I mean, how is your situation?
Thanks, Hans, for the questions. I mean, we are in a luxury position, given the fact that we invest in a topic which is called sustainability, and is called even better than that, sustainable food. And as we all could realize during the pandemic, food becomes kind of number one priority in all our lives. Jokes aside, I mean, we had really no emergency in portfolio. We have currently 15 companies in portfolio. And we have seen obviously a bit of mixed impact. Some were suffering a little bit more because they couldn't do in-person business meetings, sales meetings. Others have clearly benefited from it because they were in delivery. And so that has been obviously high on the agenda during the crisis. But overall, it has been a relatively smooth ride so far through the crisis. From a portfolio point of view, and I think we'll talk about investors a little bit later. Nothing major there. We have seen some valuations dropping a little bit, maybe along the lines what Ken mentioned, just 20-30% drop while we were making deals, given the uncertainty we had. In terms of deal flow, it has been a steady flow since we started. We haven't seen a spike in opportunities. It has been always very high since the inception of our fund. Almost 2 years ago, we've reviewed more than 1,000 opportunities in that space. So we don't complain about deal flow or opportunities.
I mean, Michael, you invest across Europe and the US. Do you see any difference between the impact of the investments in Europe and the US?
No, it has been pretty much similar patterns across the board. Yeah, we do Europe, we do US, and rest of the world, and there hasn't been super specific differences in terms of how entrepreneurs acted with the crisis.
Okay, thank you very much, Michael. Vincent, I mean, you invest in Swiss venture, right? So with basically 2 Swiss university innovation hubs in Lausanne and Zurich, and some other major venture initiatives in Switzerland. I mean, what was your Corona experience so far?
I'd say panic at first, and then mostly people in the middle of fundraising that thought, wow, maybe we should have closed before. But all in all, I think the 2 main takeaways is flight to quality and flight to later stage. And also for Swiss startups, much more money actually coming from Switzerland and less from abroad. In terms of valuations, I think the gap has spread a lot with highly visible and later stage startups maintaining very high valuations and closing even during the second quarter of this year. And the ones that are earlier stage or less visible really struggling even more than before. So I think it has, as in other sectors, created a bigger gap more than anything. I think in the US, we've seen for the first time late stage investment outgrowing early stage investment. I think it's the first time in 5 years, which means that investors are much more risk averse, like Ken said earlier, but that also creates a lot of opportunities because the valuations of good and strong early stage startups has been going down very quickly. And I've been part of 2 closings recently in seed stage, A stage. Well, never really know which stage you're at, but early days, let's put it that way. And they made it, but it was mostly as we usually do in Switzerland with friends and family. So it was harder than planned. So all in all, flight to quality, less risk. And you really also need a lot of visibility and be in the right sectors. Obviously, if you're in the food sector or in food distribution or work from home sectors, they have a name for that now that I forgot. You're well off. In other sectors, I think it's harder.
Okay, thanks, Vincent. I mean, Mark, valuations have been a hot topic over the last couple of months, and I think we hear that from all different participants on the panel. I mean, with dry powder becoming more and more difficult to unlock and finance rounds were slowing down, I mean, people are scared by a number of developments, right? I mean, what is your take on the VC valuations in different sectors? And what is your view in terms of the impact of COVID on VC investment activities in general?
No, thanks, Hans, for having me, and thank you for the questions. I think a lot have been said, but one of the trends I think we've seen in the last couple of months, and I would say even prior to COVID-19, was the fact that, and we were very much since the beginning at Seeds Capital conscious about that, is to be careful in terms of valuations, simply because we've seen over the last couple of years now, massive multiple expansion on the back of, record dry powder from a lot of funds, and not only in the VC world, but also in the private equity world. And this has just pushed, a lot of money, not only into good and healthy companies, but also into, less healthy ones. I think what's been adamant and very clear in the last couple of months
is there's been, as Vincent and others have said, a flight to quality, but I think more than that, a flight to companies, and not just, chasing value, but also growth, but actually companies who have a healthy cash conversion cycle. So if you can prove that your business model, can sustain, shocks, and you have healthy cash flows and sound working capital needs, these companies will continue to thrive. And even if we've seen, to some extent, especially I would say in the earlier VC rounds, maybe some, discount to old valuations or, a couple of quarter valuations ago, some of these companies are still doing extremely well. And you see it in the public markets, right? In the public markets, tech, and healthcare have been hailed and are continuing to do well. We see that to some extent also in the VC world, but you also see that a lot of players have been hit hard. And you've seen it, with very large names, whether it is in the hospitality space and in the likes of Airbnb, or a lot of new technologies now. Even if it's on the sustainability route, I think Michael said it very clearly. Sustainability and impact is a very hot topic and thematic which a lot of people are chasing, but it's an unequal world out there. If you look at new ride-hailing companies, in the form of all the new scooter companies, they've also taken a massive hit, because I think everybody is repricing valuations in the form of what is the real growth factor, and what should we be paying for that. So I think going forward now, what is extremely difficult, and I think for a lot of investors, is, well, where do I put my money, right? And these equity risk premiums, which everybody is chasing, and that's why equity markets, especially the public ones and technology, have done well. Whether that is going to continue, and that is why we very much share a similar vision to our friends at FCC, for example, and Ken and his team, in terms of, well, how can we chase real sustainable growth? And I think that's the hardest part right now. And I think that's where I think investors more and more are going to focus on. But when we see investor sentiment in general, what's quite interesting is investors, and even the smartest investors we've seen, very few are consistent. And what I mean by that is, I remember when COVID started, everything people, or I would say even I take 2 steps back, 8-9 months ago, we were saying to everybody, let's be careful with valuations. And we couldn't foresee, obviously, COVID-19, but we were very scared about the state of the market. We're at the end of a cycle. Leverage ratios are at their absolute highest since 2007. And so we said, we need to be careful when we actually, put our money to work. And a lot of investors there were still chasing, like herds, huge valuations. Then suddenly people got scared and said, well, now actually, we need to make sure that we're not chasing that anymore and going to very safe assets. And 2 months later, they wanted to be correlated. So I think you're going to continue to see, and that's the driver also, the volatility behind the public markets. And to some extent, we will see that translate into the illiquid or private markets in the months and quarters to come. So I think you need to remain very consistent in your messaging and pursue, I would say, long-term trends which are sustainable.
Yeah, thank you very much. I think that was clear, man. Maybe let's focus over the next couple of minutes on very specific topic which relates to artificial intelligence. Ken, maybe a question to you. I mean, how do you see the application of artificial intelligence in venture capital, and more particular in sourcing and underwriting and portfolio management and portfolio monitoring? It seems that some US venture capital organizations already actively use artificial intelligence. I mean,
I'm sorry, I needed to turn mute off. I apologize. I was trying to avoid background noise. Thanks. The way that we view artificial intelligence is we view it as being able to continue on the singularity of human efficiency. So I think we can all agree at this point, it's been a fascinating situation to have such large global growth over the last decade, but not have any inflation. And despite the amount of money that governments have actually printed, especially during COVID, we still have not seen inflation take hold. Why? Because of technology and the singularity that it is creating in efficiency, so that you can continue to keep prices down with the proliferation of ever increasing efficiencies from technology, extension to that being artificial intelligence. So one of our companies that we invested in was a company called Looker. If you're familiar with companies that provide a dashboard to middle management, it gives you an output of what went right in the business today and what went wrong. Okay, so with Looker, if you can put an extra layer on top of that, it can actually start taking actions for you. So imagine the example of a pallet at a warehouse not being shipped. Everyone goes home for the night. Normally, a middle manager would receive a dashboard that says when they walk in the next morning to work, there is a pallet that was expected to ship last night that was missed. You need to ship this today. You're actually working in systems that have artificial intelligence and that are working with each other's systems. Once that pallet is discovered not being shipped, your systems can say, through your HR system, notify an employee to be at the office 1 hour in advance tomorrow. The shipping service has been automatically notified that a truck needs to be at the warehouse 1 hour in advance. The customer is notified that the shipping was missed and it will be delayed 1 day. So now as a business manager, you walk in and you see this is what was wrong, but these are all the things that have been taken care of, and it was already shipped 5 minutes before you got into the office. That level of efficiency is going to continue to keep this singularity of efficiency through technology with us for decades to come. And so it's just systematic into our business now and those companies of which we look to invest in.
Yeah. I mean, you're referring to artificial intelligence as an example in one of your underlying investments, in one of your underlying target companies, but how is it basically dealt on a venture capital firm level? I mean, it seems that in the US, much more data is available on VCs, and artificial intelligence seems to be applied already in a number of venture capital organizations. In Europe, the market seems to be kind of much more intransparent. I mean, the use of artificial intelligence, is that hampered somehow by the lack of data availability and lower level of market transparency on the level of venture capital firms? Maybe also a question to Michael.
Yeah, you're probably right. I mean, we are kind of still on the traditional way of sourcing, connecting, networking, and deal making. There is obviously less data in Europe available. The data is more scattered, which means that it's more difficult to use it. And honestly, we for the moment are still not deep diving on that area. That's why my comments are probably a little bit limited.
I would say, if I can jump in, I'll add to it, is that from a sourcing standpoint for venture capital, it is largely seed or very early stage that artificial intelligence sourcing works. We are a late stage firm. We typically invest in companies that have about $100 million revenue run rate. So it doesn't necessarily touch us. But when we view venture capital, Mark was very kind to invite me to a conference that he was supporting. I talked about two key things in venture capital. There's access and there's influence. Largely speaking, everything after seed, access is less relevant today. Why? Because of the proliferation of social networks and LinkedIn, we are all 1 degree separated from, I think, any entrepreneur in the world we could get to through some connectivity. But if you're looking at seed, that access and artificial intelligence is actually a differentiator in my view. If you are looking at these large data sets, whether they be, for example, a software company in the United States called Second Measure takes credit card data and analyzes trends in that credit card data for specific companies and industries. If you're receiving daily feeds from that, you can see inflection points in certain companies' businesses where you're not necessarily getting access, you're getting signal. And then you will revert back to access to find that entrepreneur. So I think it's very interesting is some people use the word sourcing with artificial intelligence in seed investing. I think the better word is signal. You're trying to get signal to where then you activate on access and then activate on influence, which is convincing that entrepreneur to work with you.
Okay, thank you very much. I think that was also quite helpful. Let's just flip to the fundraising side and to how you deal with investors at the moment. I mean, Mark, which current trends do you see in the global fundraising activities of VC GPs? Is there a standstill? Are they kind of in a waiting mode? Does it depend on the geography or on the business where they are into?
Yeah, very good question, Hans. I think there's 3 categories we can probably box investors into, and mainly it's driven by sentiment, and that sentiment is also changing. I would say almost week by week, but certainly month by month in terms of how we're evolving. But you got a first category investors, and these are mainly, I would say, private investor, family office type, or semi-institutionals who are completely shell-shocked and basically are saying, well, we now need to completely, focus on our current portfolio, which I'm always amazed because I wonder if they weren't doing that before. That's concerning, and which are basically saying, well, we don't have time for anything, and we're just basically looking at the markets, going up and down every day and reading the press. And then you have a second batch, which is more of the same, but who are very hesitant whether basically they should be completely changing their strategy or asset allocation, depending on the, I would say, economic consequences which we're facing, and can't decide whether they should be more diversified or more correlated to markets. And that is also, I would say, a rather indecisive group, even though we're seeing more of them now putting money back to work. And then you have the third group, which is, I would say, the more rational one, which I'm trying to deal more with, even though it's complicated because they're a rare species, which are simply consistent with their asset allocation, understanding what's happening, and trying to be very rational. They would not, I would say, during the last 3 months, which I think were tough for everybody to do fundraising, wanting to have any kind of fundraising discussions, but it was more about reassuring those groups in terms of what the portfolios are doing, what we're investing in, the trends we're seeing, sharing the opportunities, and trying to have very concrete discussions with them. What we're seeing now, since I would say end of May, mid-June, is I would say people reconsidering allocations and understanding that money has to be put to work somewhere. I think what's very difficult is obviously the choices investors have in front of them in the current environment, because fixed income is basically giving you nothing or negative income, and so that's a conversation. There's a lot of education going into it, which we're doing and which we're fine with, but I think it's getting easier. I think the tough part right now is people, even though they're getting accustomed to video conferencing as we're doing now, is I would say the lack of person-to-person interaction, and it makes it, I think, even more difficult for when you have as an investor to invest directly into companies, because at one point in your due diligence process you need to meet people, and that's a process which will not disappear. You can do just so much over video conferencing, but then there's always an element which you cannot complete. I think that's really kind of the environment we're finding ourselves in. In terms of future outlook, I think it will get better, but I don't think that the fundraising environment will come anything close to what we've seen, I would say, last year, despite the fact that a lot of institutional money has more and more cash on their hands, which they need to allocate.
Thank you very much for that one. Michael, I mean, what is your experience regarding your existing LP relationships? I mean, did you have to increase the reporting frequency or data volume which you share with which you have shared previously with your LPs?
I mean, we were really and are still in a luxury situation, and we've all been fundraising. And when you get to a point that you get inbound interest on the info email, then it gets scary or it gets crazy. And we had not one dozens of it. I mean, it has been really, really hilarious to see less the private ones, but the corporate world and some institutionals who, I mean, there's not that much where you can invest if you do sustainability and food. There's Beyond Meat in our space publicly, and then there's little less. So we kind of are one of the few options, and we had a lot of inbound interest, which have converted already into tickets. We have LPs that have doubled down their ticket while we are still in the fundraising process. So this has been clearly amazing. We had one who canceled the ticket and one who reduced it during that process. But that we were just lucky to, I mean, spot on right sector, right momentum, and that was really, really helpful for us. And it's going on. It has not been something which came off and on. It continues, because obviously in the aftermath, well, for us in Switzerland, in the aftermath, for others still in the midst of COVID, I mean, the topic of, how do we feed the planet? How do we save the planet? I mean, it's getting more and more important, and that, I mean, investors start to react to that, which is good to see. So I can't complain.
Thanks, Mike. I mean, Ken, what was your experience over the last couple of weeks or months in terms of speaking to your existing LPs?
Our observations are the following. We have seen a flight to quality. That is, whether you are a limited partner or whether you are a general partner. Vincent had said this, is that it is really a flight to quality. There has been a shift to the late stage. Here are the things that are different that we see. In 2009, after the global financial crisis, LPs had a denominator effect. The value of their public stocks had declined, and they were over-allocated to venture. We have not seen that. Conversely, we have seen the public markets do extraordinarily well. To Mark's point on valuations of private companies, the 10-year trailing average of next 12-month revenue multiples for software as a service companies is about 9x. Today, the highest performing software companies are trading at a 16 times next 12 months. So the LPs have seen this significant growth in their public market books. So as Mark also indicated, there's a substantial amount of capital that needs invested. We have seen the LPs use that capital at a flight to quality. Those managers, one, that they're already invested in, or two, managers that they've never been in and have never been given an opportunity. As an example, say Sequoia, that they focus on. So it is interesting that over the last 6 months, Sequoia, NEA, Lightspeed, Blackstone Life Sciences has all raised greater than $4.5 billion worth of capital. Yet there are 2,250 venture firms globally trying to raise money right now. So there has been this flight to quality. The second thing that's really taken hold is this concept of persistent returns. So Josh Lerner at Harvard University did a persistent study that says if you are in venture and your previous fund was in the first quartile, there is a 68% chance that your next fund will be either a first quartile or second quartile fund, and a 48% chance that that fund will be first quartile. So there is almost a 50% chance if you were first quartile last fund that you will be first quartile this fund. Juxtapose that to PE, it's about 20%. So LPs have really gleaned on this persistency in venture returns and have pushed their money towards those funds, which have been previously first quartile funds. For us, we're on our third fund. I'll give you some metrics. The first two funds were upper quartile. Nearly all of our LPs came back in, plus new LPs. Juxtapose that to an early stage fund that is on their second vintage and returns are not visible yet. Those firms largely have been struggling for institutional money. I'll pause there.
Okay, thank you, Ken. Maybe Vincent, I mean, given the pressure on venture capital over the last couple of months, if you like, I mean, do investors ask for additional protections, and will governance be increased in venture companies? I mean, you are sitting on a couple of boards, and I think you have to deal with these types of questions, maybe not on a daily, but certainly on a weekly basis. I mean, what's your take on that?
I'd add to the point on flight to quality, to flight to discipline. I've seen a lot of crazy things in the venture space here in terms of valuation and growth and crazy valuations. And I always say, if you give me 15 million, I can open many stores as well. But this is not venture. There's no innovation. So there was a lot of money flying around for companies that were just not venture, but they just had the tech aspect to it. And so, I've seen many different companies here very successfully raising money. I think that will stop, because when the music stops, they will be in real trouble operationally. I think that in Switzerland, it took a lot of time for the state to come up with some sort of solution, going back to your question, Hans, for startups and for venture. I think they thought that somebody else would take care of venture, and rightly so. Also, they thought that SMEs, which is the backbone of the Swiss economy, small and medium-sized businesses, were the first ones that needed help. And they provide, 85% of the jobs in Switzerland. So I think the focus was relatively correct. But they don't provide that much growth today. So, finally, it took a long time. I think a lot of startups really, really, really struggled. And I've seen a few having good products, having revenues, but just, having to pay salaries and in the growth phase. And they still struggle today. And it's obviously very hard to raise money when you're almost dead or it's too late. But it's not too late because they did a bad job. It's just too late because they were in a sector that just stopped from one day to the other, and they were not big enough yet. And so that's the beauty, I guess, of early stage. But I think in general, at least here in Switzerland, if that's your question, the state has been very responsive and very helpful in many different ways. And also very flexible, dealing with your workforce, dealing with financing, etc. And I'd say the only thing is that probably banks have not been that supportive, but that's not really new. We're a wealth management country, not a real banking country. Unlike what many people think, we have no clue what credit is. We only do asset management. So that has been a problem to a certain extent for some relatively bigger startups.
Yeah. Okay. I mean, Mark, what's your view on when going into venture investments in terms of additional protections and governance of these investments? What is your approach to these issues?
One of the things I think which is worth saying, I think some investors know that and some might not know that, is we do that a lot, is we benchmark every asset class, against each other to try and find where the best risk rewards are. And in general, if you look at the data going back 25 years, venture capital as an asset class is not a great asset class. And so, and a lot of people often say, but wait a minute, there's some great returns. Yes, but if you look at the mean or the average, it's actually quite poor. So it's completely inefficient, and it's way too risky for the amount of the average return compared to even private equity, growth equity, or any other type of equity strategy. However, if you now look at the top and bottom quartile, so the dispersion is extremely high, so a very flat bell curve, you see huge outliers. So if you take the best venture capital firms out there, yes, then the risk reward is much more appropriate. The problem is how you get access to that, and whether you're in the right time of the cycle. So what we tell investors very clearly, we try to shy away in general right now, and have for the last couple of years. In venture capital, we've been doing way more 10 years ago. And shied away. That doesn't mean we do not, invest at all. It means we have to be even more selective. And so one of the things definitely we're looking at, and we can call it, flight to quality or whatever, it's really more, are companies able to sustain, certain cash crunches, right? And we've seen a lot of companies, no matter how good their business model is, how great the entrepreneur is, not having great working capital setups, and therefore not managing to come to cash conversion fast enough, and that's put them in a really difficult position. Certain of these companies lie in between, that also enables investors like Ken and his fellows to be able to pick up companies at great prices. So every crisis shows an opportunity, but we're very adamant to make sure that we're going into quality, into companies which can sustain that. And if you have companies with another 18, 24 months of runway or more, and can sustain a prolonged crisis, they will come out on top, and they'll come out in an environment where there's going to be less competition, with might be a smaller market, but will they have a lot more market share than they have today. So that's kind of where we're telling our investors where to put their money in, and how we're looking at the venture capital space ourselves.
Yeah, I mean, or you guys have spoken a lot about flight to quality. I mean, Mark, who are basically the winners of the current crisis, and who are the losers? Is that possible to go into that question a little bit more?
Are you talking in terms of companies, or are you talking more about firms in general, so asset managers, or both?
I would say in terms of industries, right? I think what you certainly see that is, I mean, remote teaching, tech infrastructure, right? I mean, that's on the one hand side. I mean, you certainly see a big impact on, I don't know, hotel and travel suppliers who is struggling heavily, right? I mean, what is your view on kind of these different areas? And who ultimately will be a winner, and who will be a loser, and will the losers, if you like, be in a position to catch up over time?
Yeah, so I think a lot of firms had to adapt. So I think, of course, the advantage, in venture, or I would say for a lot of venture companies, that they had of a tech angle. Today, to invest in technology, I wonder if it's even an industry. I think every company has some degree of technology. It's more kind of, are you innovating, and are you managing to use that technology to really basically, make your business model as efficient as possibly. So any tech-enabled company, or with a heavy tech component, and especially which can actually exercise their activity remotely, has been a winner. I mean, even if you look at the financial industry, they haven't suffered, unless you're a pure play commercial bank, as many industries have, because most of them were able to to work remotely. So I always laugh when I see big financial companies who have had practically zero loan exposure firing people, because they're taking that as an excuse to basically have huge social plans in place of firing people. So I think there's a number of industries which, obviously, if you look at entertainment, travel, hospitality, and even traditional industries, which are, heavily hit. Even in these type of industries, you find, I would say, a lot of, smart players, which either play, the logistics around that, or certain, other type of derivatives, which can still work. But for sure, today, if you look at, I would say, technology in a broad sense, or, SaaS type companies, B2B to C type business models, or logistics in general, it's hard to say, well, there's one industry who's going to just, overperform another. I would say there's simply certain industries which are going to be more challenged for the coming quarters. And everything which has, I would say, a heavily non-tech, biased, I would say, element to it is going to be more challenged. But even there, depending on what, situation you're in, you do find niches. We invested, for example, in a logistics company 18 months ago, which is not that, tech enabled, but we almost kind of have, a monopoly in the space, and people, use it as an essential service, right? So something which cannot go around and which is essential will continue, to work well. Traveling, airlines are not necessarily essential businesses, except if you're in pure logistics or cargo, you might survive. So I think you cannot really, pinpoint it, but I would say definitely tech-enabled, healthcare-enabled, or healthcare sector-oriented companies will probably do better in the next couple of months. However, that is, I do think, and that's what we look for as well, is there are a number of industries where you will see, tremendous shock and opportunities. And if you're patient enough, and that's what we tell all our investors, you need to do the homework. There are certain industries that will not completely go out of business. So if you're patient enough and are able to do that homework and look at some of these companies in specifically hard-hit industries, you will find value. I think right now it's very hard to invest in value because there might be value traps. And so that's why everybody's, chasing growth. But I do think it's worth your time to be looking at certain value plays in specifically hard-hit industries, which will not completely disappear.
Okay, thanks, Mark. I mean, Ken, what's your view on potential winners and losers?
Our portfolio, we did something similar to a bank stress test when we entered COVID. There were a number of variables. You had, strength of the balance sheet, unit economics of the business, experienced management teams or not, the ability to cut burn. There are certain things that were hit very hard. There's a company in our portfolio that does wedding planning. Well, there's not a lot of people throwing weddings right now. You could obviously see that that's going to be a situation where you need to activate quickly in terms of managing your cash burn. Because at the end of COVID, people will get married again. This is not an industry that will go away. So it's patience. And then and the patience part of this is borne by equity investors, not governments, not banks and lenders. It is borne by equity investors. So those equity investors that acted quickly with their portfolio companies, managed for the long term, made sure that in a distressed environment, the unit economics of the business were still sound, will benefit post-crisis. For us, there is a great number that have cut very positive. You could imagine we are investors in DoorDash in the US. The delivery of food to the home has exploded. There are other, food-related entities. As an interesting point, we're invested in a company that focuses on dog products. In the United States, it's amazing, but the dog shelters for homeless dogs are empty because everybody during COVID went out and got a dog. So you've seen these really long tail outcomes which you didn't underwrite to come to fruition. So what we tend to do is focus, again, like what Mark said, on the core unit economics of the business. For our current fund, we have 8 companies. We chose not to invest in March. We did not invest in April. We did not invest in May. And like what Mark said, we needed to be patient. So in June, we started to invest. we have invested largely in enterprise software companies as we continued to see what the consumer was going to behave about during COVID. And now we have made our first consumer investment in the portfolio. But all of those companies are at, on average, 120 million of revenue, growing 120%, with 70% gross margins, and have burned less than 100 million of equity to get to 120 million of revenue. So it's that discipline around getting the data of the underlying customer through the company to then make those investment decisions. And I think, as Mark said, patience was very important early on. There will be opportunities, and there is going to be this period of time with the second wave of COVID that patience will be rewarded again. And being judicious with the pen on the checks.
I mean, thank you very much, all. I mean, let's go into the last round of questions, and maybe, I mean, we've spoken a bit about it already. I mean, the future trends of Corona and how BC will look after the Corona crisis. Maybe a quick statement from each of you guys. Maybe Vincent, you can start. I mean, from your perspective, how will VC look like after the Corona crisis?
As everybody said, I think flight to quality. I think patience will pay because there will be value traps. Definitely, we already see a few. Because when something decreases significantly in value, there's usually a reason, and it's not necessarily an external reason. And I think discipline. I mean, venture, as any other type of investment, should be about discipline and should be about the people. I mean, I had a look at Ken's website, which I think is pretty clear about that. It's about the people, especially in the venture space where you have to do a lot with limited resources, coping with a lot of growth. And I hope that most of the venture players will be disciplined. I think it's becoming really hard for first-time funds, and it will stay that way for quite a while. And so I think that the existing investors have to be very disciplined. And yes, they will have great opportunities, but it will take some time. What I feel and see a lot, I see different types of investors. I see very large single family offices that are investing massively currently because they think it's in crisis times that you make a lot of money. Most of these family offices have made their money in this generation or the one before. What we have a lot in Switzerland is old money that is very scared and that is not, completely shell-shocked, and they have no clue how to make money. They're not entrepreneurs since 10 generations. And, they're completely panicking. They did some venture because it was cool, but now they realize that, the stakes are higher and they can potentially lose their lifestyle and that they will not be able to make the money to, bring back that lifestyle again. On the institutional side, at least in Switzerland, we lack a lot of professionalism, unfortunately, especially in the private market. So venture, private equity, you name it. Everything that's private has been very poorly covered in Switzerland. Unlike what people think with Partners Group and others being in Switzerland, it's a disaster. And I hope that will change. The current equity markets don't really help, but we will see. But in general, flight to quality, discipline, and it's also about the people. You can have the best idea in the world. If you don't have the right people, you're going to fail. And that's a general observation I see in venture in Switzerland, is that we have great innovators. You mentioned PFZ or PFL and all the schools we have, but we lack managers. When these companies start to take off, we don't have the managers to manage them. That's what they have in Silicon Valley and in other places where you can combine some very strong CFOs, COOs, and managers with the tech and the innovation. And in Switzerland, I hope that will come more and more because it's really lacking now. And that's also why some of the successful startups we have leave Switzerland, and many people criticize that. I don't think it's a lack of money; it's a lack of talent, unfortunately, and experience.
Okay, thanks, Vincent. I mean, Michael, maybe a final statement from your side. It seems that you haven't been so much impacted by COVID, but how do you see venture after the corona crisis?
Yeah, I mean, a lot has been said. Venture is about the teams. We operate on global scale, so the limitations we might feel in Switzerland do not really apply to us. We do see post-COVID a movement from entrepreneurs into the space. I mean, it's becoming crystal clear that there is capital available for innovation and starting up a business in sustainability areas and in food very especially, and then with ETH, EPFL, Nestle and the likes. Obviously we are kind of spoiled in Switzerland, but it's even for the Swiss entrepreneur, it's a good terrain to start off with. And we would expect more deal flow and more investors. It's just, for us, it's really early days, so we are kind of in a super expansion mode. And that's, as mentioned, that's even accelerating.
Okay, thank you very much. I mean, for all your input. I mean, we have a couple of questions from the people outside. I mean, let's maybe go through one or two practical questions which we received. I mean, maybe a question to Ken. There was one question raised: how do small, mid-sized funds deal with the financial controller CFO function?
It's a great question, especially with the level of compliance that has been mandated by the governments. It puts an even greater tax.
Maybe Ken, the next question to it is, I mean, with ever more regulatory burdens on VC, how do newly established funds deal with the increase in fixed cost base?
So I have a really good answer. We have decided to bring in a consultant team to manage the largest part of our financial compliance and LP reporting. It is a group out of Salt Lake City. We have interviewed them, as well as many others, where we are going to outsource roughly 75% of our finance operations. We were introduced by this group from Silicon Valley Bank, who is our strategic partner, who uses them, so they're well vetted. And what that is going to do is going to allow us, as a mid-sized firm, those who raise between $200 to $400 million funds, to operate with a CFO and a controller. And that will help us create scale fund over fund. It took us 3 years to make this choice, but we did find, just exactly as this question was raised, an inability to hire a staff economically to cover the significant burden of the regulatory environment and the financial requirements of both the regulators and our LPs. So we think that it is an inefficient market. We actually don't think that, it's our belief that a large portion of this burden should be borne by these firms individually. They should be shared across many firms. And now there are organizations in the United States that are doing that. And this firm specifically is called Strata, STRATA.
Okay, maybe a final question to Michael. We got another question. Maybe VCs can share how they attracted LPs that are new to the industry, which the fund is focused on.
Could you repeat the question? I didn't get that completely, sorry.
The question is basically, how can you raise money from people who are not really familiar with your strategy?
They talk to me and I could convince them. So here's my email, michael@pluralhorizonventures.com. Just call me. And the topic is really, the more you dig into it, and some of you I know have been shown certain interest, the more you dig into it, the more it becomes hilarious how mankind has gotten so far in that topic on food system and sustainability, plastics and food waste and blah, blah, blah. So the moment I get 10 minutes, I don't know whether someone will invest, but another day someone told me this is the easiest fund, and we are first-time fund, and we have raised our cap during fundraising, so we are completely different to all what we've been hearing so far. It's so one investor said, this is the easiest fund I've ever pitched to one of my investors. It was a multifamily office. Said, I can explain that in one sentence. In one sentence is, we will be eating differently in the future. You want to participate in that or not? Period. So
I think that makes sense, and I think you need to be clear on your value proposition, right? So thank you very much all on the panel for taking the time and discussing a couple of interesting topics with regards to venture capital. I think the credo was ultimately fly to quality, right? And be persistent on your way how you invest. I mean, thank you very much to all our panelists for this exciting discussion. It was a great pleasure to host you. I hope you all enjoyed the web event, and we hope that you will also join our next private markets roundtable with leading European and offshore private funds lawyers, which will discuss the trends on private fund formation and investment trends, which will take place on the 15th of September 2020. I mean, if you have any questions on the topics which we have discussed today, please get in contact with us, or please get in contact with the panelists directly. Thank you very much, and see you next time, and have a nice summer break. Thank you very much.
Thank you all. Take care. Thanks, Hans, for the invitation. Bye.
Thank you all. Thanks, Hans. Stay safe.